But I want to get your take on the real estate market. As always, you've got a good eye to the ground of what's happening. We got this report out from Redfin that points to sales hitting an all-time low, but we're looking at the number of homes for sale at an all-time low. I will tell you, as somebody who has been looking, it was incredibly depressing over the last week to see the amount of inventory, and you go from open house to open house, a caravan of people coming in trying to compete. Are we at the peak, you think? Are things going to start to slow down next year?
I'd like to say we're at the peak, or at least promise a slowdown, but no, I think it's going to get worse before it gets better if you're a buyer, or better before it gets worse if you're the lucky home seller. But homes in November always go down, the quantity of homes, but they went down 23%. I've never seen that happen before. I've noted that on those homes that sold in the month, they sold in a week or less. Think about that. That's bizarre. The housing market was bonkers. Now it's still nuts and it's getting worse. But of all the shortages affecting our economy, I'm sad to report that I think the housing shortage is going to last the longest. I don't think you're going to have better luck shopping for your home next year. I just don't think so, unless we increase interest rates by 3-4% overnight. Boom, that would drop the market. But anything short of that isn't going to make a difference. Come live with me. It's okay. I'll see you.
3 to 4%, the number to watch there then too. I mean, it's not just home sales too, though, Barbara, when we're talking about all-time low in supply, but also when you look at the rental market, that's another one where historically winter is kind of the one area of the year where you start to get some breaks. I was out in that market. Kiko might be looking to buy, but I was renting. We've seen rents, according to that same report, jump about 14% year over year, which is wild to think about too. So, I mean, how does that market look in relation to maybe buying, just kind of given you got Omicron to worry about now too. And so I don't know what's up and what's down in buying versus renting.
If you're expecting rental prices to go down, you're mistaken, because what happens is when people are priced out of a purchase market, what do? They fall back on rentals, even if they really want to buy. So no, the rental market, if you wanted to save money, we had a slight opportunity. It lasted about 3 to 4 months, and it was about 8 or 9 months ago. After that, it closed up, and believe me, I'm a landlord. The landlords are making up for lost time. Whatever they shortchanged in those 6 months, like, oh, I'm going to take advantage that I have 3 people who want this apartment. You have the long lines on both buying an apartment or a home, and you have the long lines on renting a home or an apartment as well.
I mean, that sounds pretty depressing.
Well, what are your options? You could live in a tent, I guess, but even those prices are going up from what I hear. Sorry, I don't.
Well, I was going to say, Barbara, I mean, you're looking at both sides of the coin, right? Zach just renting. I'm looking to buy. It sounds like you're saying neither is going to improve. I mean, do we just stay put?
You could stay put, because if you're in some kind of a regulatory environment, which we have in New York and a few other states, you're regulated as to not to be priced out of your rental, for example. There's just so much increase a landlord could ask for it. But anything short of that, no, it's open game. I mean, you know what? The best thing to do is to both of you change jobs immediately and ask for a lot more money from the next employer. And then you could afford to get whatever you want.
Yeah, it's good advice. It's good advice here, Barbara. Actually, it hits close to home. When we're talking about maybe the other things out there, we've talked a lot of real estate bubbles, right? But there's other sectors of the market some people might be playing. I know your co-host, Kevin O'Leary, and I have chatted many a time on crypto. I'm curious if you've started to look at that space at all, just kind of given some of the crazy returns we've seen this year, if you've maybe started to diversify maybe a little bit more away from real estate because of the price increases we've seen. How have you been maybe looking at that?
Well, I've migrated, maybe that's not the right word. I've taken a lot of money out of real estate in New York because I think it's priced so terribly high as an investment right now. And I've looked for other smaller cities to invest in. Right now, I've invested a lot of money in Pittsburgh, because Pittsburgh is like the perfect storm right now. It's got a friendly government. It's got the most educated working force in America, and it has big business moving in there, specifically technology businesses, and prices are deflated. They shouldn't be. They're catching up, but you can make a lot of money. So I love real estate. You can't ask me to take it out of real estate, but I did. Well, that's real estate too. I did invest in Zillow. Remember you asked me last time, you're going to invest in Zillow? They just crashed. I did, and I've lost 2 points so far, but I know I'm going to make a fortune. I know I'm going to make a fortune if I just hang on there, maybe another 3-4 months. I think they're doing better than everybody expected. But where do I invest? Where do I take my money out? I'm so sorry to say I love real estate. I trust real estate. It's a very, very slow way to get very, very rich.
Well, rentals are booming in the U.S. as the real estate market recovers from the COVID-19 pandemic, and demand for apartments is soaring to new heights. In most major markets, apartment occupancy rates are holding steady above 96%. That marks the highest levels ever recorded, but will that momentum hold? Joining us now for more on that is RealPage VP, Head of Economics and Industry Principles, Jay Parsons. And Jay, I think a lot of people last year experimented or experienced, I should say, some of this if they were trying to get apartments like yours truly here. But record level occupancy doesn't make me think that any of that pressure is going to wind off in 2022. So what do you see shaping up?
Yeah, it's been a remarkable year and a half for apartment demand and really demand for all types of housing. So as you pointed out, record low vacancy in apartments, but it's the same story in single family rentals and obviously for sale homes. And so with that tightness across the board, it doesn't look like you're going to see tremendously more availability in 2022.
I mean, what are we talking about? Is it just the major cities that are seeing that kind of occupancy, or is it pretty much across the board? I mean, obviously, yeah. I'm based in New York. I've heard the stories. I know how competitive it's been. What are we seeing in other markets?
Yeah, it's a good question. What's unique about the current market is it's hard to find a vacancy anywhere. We track 300 plus MSAs across the country. There are two that have high vacancy, and they're two tiny markets in Texas, Midland and Corpus Christi, and maybe another one in North Dakota. But it's all over the country, every market, at every price point. Everything is full. And it's really unprecedented to see this much demand all across the country. It's not concentrated in any one spot. So where places like New York and San Francisco experienced a real roller coaster where you had a lot of move outs in 2020, followed by huge demand in 2021, the rest of the country really never saw many move outs for the most part, and then continued to see the same massive demand wave that started in the summer of 2020 and then really accelerated in 2021.
And I wonder too how much of that really just came from concessions. I mean, you're talking about kind of maybe, and not every story is a New York story, but here in New York, there were a lot of concessions to get people in or have them stay in apartments in the pandemic. And now I guess maybe we're starting to get into some of the zones where those are rolling off. It's time to renew. And now people are staring down some pretty high prices now too. So, I mean, how does that shake out in terms of maybe pushing out some would-be renters if prices stay that high?
Yeah, it's a great question. We really didn't see concessions except in kind of core downtown areas like New York City and San Francisco and some central business districts across the country. Elsewhere, we didn't really see that. And the big concern was that, exactly like you said, is that as those concessions wear off, that we would see a lot of people who weren't able to afford the rent. And thankfully, it's not been the case. We have seen unprecedented growth in incomes for apartment renters. We saw the average apartment renters made about $70,000 last year, is up 12% compared to the year before. This is for new incoming renters. And so, while the overall kind of tone on rentals has been fairly negative through the pandemic, the reality is the data has pointed a much more favorable story where market rate rentals have really benefited from deep pocketed renters who are in stronger financial shape than ever. On the flip side, you have a very small share of renters who struggle to pay market rate rent prior to the pandemic. And that's largely who continue to struggle now. And that's really a different problem. That traces to the lack of affordable housing and funding for affordable housing across the country.
Jay, you picked up right where my question was. I mean, how much of these high occupancy rates we're seeing right now has to do with the lack of affordable housing that's out there? I mean, if you're talking about people who can pay their rent, they're making decent money, what percentage of that you think is being held back right now from moving into ownership because of the inventory?
Yeah, that's another good question. I think what's happening is that there's demand at all price points for all types of housing right now. So I don't think apartments are necessarily benefiting from the shortage in single family or obviously the affordability challenges in the rental housing market. I think you have, you look at the demographics, I'll spare you the details here, but there's a lot of good demand drivers for both apartments and for single family right now. And a lot of the household formation that's occurring at a really brisk clip are people who are, generally starting out, they're going to look for an apartment first. Now, what's happening obviously is you go to like older millennials and who are ready to buy a house, obviously they're going to be staying put a little bit longer in rentals when they can't find a house to buy. And so, but more likely they're going to end up in the single family rental market, because a lot of this, we make about people sit down at a kitchen table and get the calculator out, say, should I buy or they rent? But a lot of it's a lifestyle decision. And so if you're not buying a house, you're probably renting a single family house.
Yeah, sometimes you just need a little bit more space, and that's all you got to look for. But when we're looking at mortgage rates too, just to wrap up here, shifting from rental to buys, again, we've expected those to tick up higher. Now the highest level since spring of last year, or 2020 rather. I mean, when you kind of dig through what that could do to maybe some record high prices in terms of home prices, how do you see that shaping up? Because, I guess a lot of people maybe were already bracing for this.
Yeah, it's funny, higher is always relative, right? And yes, it is going up compared to these record low mortgage rates that we've seen over the last year and a half or 2 years. But, as you look at the mainstream forecast, I mean, even the most aggressive forecasts are putting mortgage rates around 4% at year end. And historically, that's still a bargain. I mean, you go back a couple of years ago and rates were actually above 4%. And so I don't think this is really going to move the needle very much. There's been several studies shown that, as mortgage rates go up, it doesn't really impact home buying unless there's a broader issue going on, like a recession or whatnot. And in fact, the last few times mortgage rates went up in 2013 and again, 2017, 2018, we saw sales volumes continue to climb. So, I think that both rentals and homes, single family home for sale homes, I think we're going to see prices continue to increase, but not at the same levels that we saw in 2021. Mortgage rates play some part of that, but I think it's a broader story than just that. So bottom line, though, is I think we're going to see a ton of demand still. Mortgage rates just aren't going up enough to really move the needle.
Well, as we've been talking about rising inflation prints and prices moving higher, and the Fed looking to accelerate their rate hikes this year. Interesting to watch mortgage rates continue to climb higher as well. In fact, the 30-year fixed rate for a conforming loan rose 19 basis points to 3.52% earlier this week. That is the highest rate that we've seen since March of 2020, so the highest in this pandemic era, raising a lot of questions about what it could do for real estate prices as we move forward. And of course, not just real estate in the real world, but also in the metaverse. Big questions around both of those things. And very happy to welcome in real estate guru and Shark Tank host Barbara Corcoran, one of our favorites, back here with us, making this a very happy Wednesday. Barbara, always love chatting. Maybe we'll start in the real world just because I think most of our viewers operate there. But I mean, we've talked about this before. Just because mortgage rates are moving higher doesn't necessarily signal a time to panic for you. A lot of people expected this to happen.
Yeah. But you know what? We saw a reaction to it right away. Was that your question? I didn't even let you finish. I'm sorry.
No, I mean, that is the question, just kind of how this will impact everything.
Yeah. Well, so far it spooked a number of home buyers because they didn't expect it. They thought that affordability window was going to stay open forever. And even though it went from what it was at 3.3 to 3.5, that's negligible in my book. It did increase loan applications up by 2%. And that's a reaction. The number of people applying up immediately and within the week by 2% says, oh, I'm a little bit worried. And I think you see that in the market. But when you actually look at the real estate market, the winter is usually the slowest part of the year. And the number of houses in December always fall every year. I mean, always rise every year. But this particular December, they just went down and the houses got tighter. There are fewer houses for sale and the prices are continuing up. So spook would be the right word. A problem, no. But the real million dollar question that every buyer has is worst over, or are we going to get surprise after surprise after surprise? And I certainly don't know. Maybe you have an inside track on that.
Nah, I mean, you're the one who always gives me my best insights here on the show. But when we talk about supply, that has been kind of the continuing theme of that being so low is kind of support for home prices. Whether you look at some of your favorite markets, including Pittsburgh or Raleigh-Durham, which we talked about, I guess that was 2 years ago now. I mean, how do you see maybe some of those factors abating, depending on which market we're in? Because it does seem like it's a fact across the country.
It is a fact across the country. I mean, some markets always do better than others. Some markets are a little bit worried, but I can't find any pockets where real estate seems to be a problem, where every buyer isn't struggling to find a home and where every seller isn't celebrating. I got how much for that house? Wow, wow, wow. So no, the market is so strong. And I believe this chit chat about the mortgage rates going up now, as long as they don't continue up, which everybody's saying they won't, but who knows? I just think we're going to have such a robust market continuing right through the following year, unless something dramatic happens. I can't imagine what. I shouldn't say that. You never know in life, right?
Barbara, let's transition from real estate to real estate in the metaverse. I mean, we've seen these headlines of so many people shelling out cash. I mean, not cash literally, but big bucks to try and capture a part of a metaverse, which I always like to say that it's not really been fully built out. How are you looking at the opportunity there?
It's crazy that it's an opportunity. I feel definitely sure that it is. How close we are to it being a big opportunity. It's just formulating now. You know, we're in the early days, right? But I think it's half hype, and real estate is always half hype and half reality. Real estate is half reality. Do I need it? Do I need a place to live? Do I need a place for my company to operate? But there are really big real estate deals being closed. I was very surprised to read about the deal by tokens.com. They bought, 100 and some odd acres of property in this metaverse. All right, crazy. When they paid 2.5 million. That's real money. That's real money. That's the largest transaction ever. That got, I think, a lot of people's attention and built a lot of confidence. What are they doing with this parcel? That's what I was curious about. Okay, how are they going to make this expenditure make any sense? They're developing into a luxury real estate hub for power brands that want a medium to display their power and their goods. So they're talking about, although there's no leases signed from what I could tell, they're talking about having Gucci, Louis Vuitton, Burberry sell their products there. Now, I don't know if you've ever gone into a virtual store and bought a product on an avatar. Right now, like my avatar, for example, this morning, knowing I was going to talk with you, I went into Vegas City, which is a very successful place. They have 18,000 daily users. You can't say that's not real. That starts to feel really real to me. But when I was in there very early this morning, maybe I was up too early, I only ran into 11 other avatars looking around, hoping to shop, but there's nothing to buy. The potential of this world, I think, comes in when you can actually sell merchandise, and that will happen. I mean, these larger companies already are in selling virtual clothing as NFTs. And so it's about marrying those two pieces. But will it happen? Of course it will. And I'm talking too much, but what's in the way? Okay, do you mind if I just keep talking?
Yeah, keep going. I always love when you talk on the show.
Okay, lock me out when you had enough, okay? But what's in the way, okay? What's in the way is limitations on the hardware. That has to be smaller, lighter. You can't walk around and purchase and try on clothing in your mind's eye with this big thing on your head. That's going to change, of course. And also the lack of technology people to develop this real estate value, okay? Microsoft, I think, just lost 100 developers to Meta. What's that? The new name, right? Do I have that right? I think it's called Meta now, right? They lost 100. So that's a problem. Yeah. Yes. The new Meta. Okay. Yeah, so that's in the way of development. Yeah.
How do you, I guess, obviously, a lot of our viewers know you from Shark Tank and kind of crunching all the numbers for real companies that have real numbers to show here. I mean, I guess, I don't know if there's a warning for maybe some of the, we talked to Gary Vaynerchuk, who of course also has his own NFT project here, but I guess there are warnings for maybe, even from him saying that some of this is so far down the road, you never know which one of these, which metaverse, since they're kind of a few built out in terms of virtual spaces where people could buy real estate, you never really know which one's going to take off. So I guess how would you look at, as a Shark Tank expert, how do you kind of look at some of these things to figure out which ones are going to be the ones that stick around and are going to be worth it down the road?
You can't. I can't. No one, they might pretend they know, they do not know. I remember when I had Corcoran Group, my brokerage firm I built, we were the first company on the internet selling real estate. I bumped into it by accident. But when we got on there, we tried everything. We had so much garbage up there. The virtual tours, I remember having my customers stuck on a ceiling for a whole week. They couldn't even get down to see the kitchen, right? We tried everything. We had no idea what was going to work. Did I at that point think, oh, this is going to be the new way real estate is sold? No, it just seemed like a advertising vehicle. And then look how quickly it formulated to the main deal in real estate sales and all purchase of property. The internet, what would we do without it as we know it today? No one sees form it's going to take. And that's the nature of a new beginning. But that this beginning would give value to people in the commercial sector, I could picture it replacing almost the entire office where you could talk at a water cooler, not a Zoom anymore, that kind of antiquated thing that's going to look old fast, but talk to your other avatar, your coworker at the water cooler, discuss things. That's not so far away. So where it will go, no one knows, but will it go? I'm convinced it will go.
All right, staying on the market, let's bring in Miller Tabak Chief Market Strategist Matt Maley. Matt, good to see you. I know you are an astute watcher of market technicals. Now, within the course of a week, we've had disappointing profits out of JP Morgan, weakness on margins there, seeing the same thing in Goldman Sachs. Stock is still getting slammed in the session. Is this a wake-up call to investors that we might see a bigger downdraft as earnings season starts?
Well, it certainly could be. I mean, one of the things we do have to remember, though, is that it's kind of weird what happens with the bank stocks. Even when they report good earnings, for whatever reason, the group seems to go down. I mean, it rallies into the earnings season. They always report at the very beginning of that earnings season. And then the stocks seem to sell off a little bit. The thing is, well, this time around, is that people are being surprised by, as you mentioned, JP Morgan, also Citigroup, of course, last week on Friday. Now Goldman Sachs. We have a number of, those are the big names, but we have quite a few names reporting later this week. So if they continue to report some of these disappointing earnings, that's not going to bode well necessarily for the rest of the group. For the rest of the marketplace. And remember, the earnings were as good as they've been this year. We're still a very, very expensive stock market. So we need a really, really good earnings season if the market's going to rally further in a face of a Fed that's nowhere near as accommodative as it was last year.
Hey, Matt, it's Julie here. We got the monthly Bank of America Fund Manager Survey this morning that showed that banks are the most held right now. Tech is where people are selling. And so when you get selling like this in the financials, what are the sort of implications and ripple effect that we can see in the market?
Well, one of the things that we get, of course, is that we've seen so much more weakness in the NASDAQ than we have in the S&P. And what you worry about as the market starts to come down, when the market first starts to come down, you have people going in and they buy, they find certain groups where they have flight to safety in the stock market. We saw that in December with 2 or 3 really big cap names like Apple Computer. They stayed with those tech names. Then they were like, okay, that's not really working because rates continuing higher. Let's go into the banks and the energy names. But at some point, when the overall market gets hit, they all go down. I mean, obviously, you'd like to see certain groups will outperform, but even the ones that have a bullish, their outlook still looks quite good. They all come down, and that's the big concern right now. Is that the banks and even the energy stocks are holding up today. But if they start to roll over, then there's no place to hide, and then people just go simply into the treasury market or gold or things like that, and the whole market starts to come down. So that's my big concern: is that people have been finding some flight to safety trades within the stock market, and they're starting to lose those now.
Well, Matt, is it time to start nibbling at some of these tech names? Because you still see them trading in tandem with the rise in the 10-year yield. But if they're so under-owned or not like right now, why isn't that an opportunity?
Well, because they're not necessarily cheap. I mean, the whole thing we have to worry about is what would happen with the Fed provided excess liquidity, emergency levels of liquidity last year. Long after the emergency had passed in the economy. And so the stock market pushed much further above the underlying fundamentals, even though the fundamentals in the economy were improving and earnings were improving quite nicely. The Fed's emergency level of liquidity pushed the stock market up just as fast as the economy, so it never was able to play catch up. At some point, we need to have the thing come back down and get closer together. So they're going to have to kind of meet somewhere in the middle. And until I think these stocks, some of these tech stocks, get more froth taken out of them, I think we're going to have it's going to be the line of these resistance is going to be a bit lower. I mean, let's face it. The CEO of Microsoft sold $370 million worth of stock, 2/3 of his holdings. He didn't do that because he thought the stock was going to go down 5 or 10%. I think he was worried that even though he's done a great job running the company, the stock is too far ahead of itself and needs to come down even more.
Yeah, it's always good to watch those insider buying and selling filings. I want to switch gears to another group, and that is the home builders. We just got out the National Association of Home Builders sentiment just a few moments ago. It came in at 83 in January versus 84 the prior month, and was the same as it had been last year at this time. I know you've been watching the home builders closely as well. I mean, there's a situation where I don't know what that mismatch looks like between the stocks and the growth, because the housing market's been going crazy.
Yeah, this is one where I think we're actually going to the home builders are starting to come down. There's been some cracks. Look at Home Depot, which has been a superstar stock last year, has been getting hit pretty hard, and the correlation between Home Depot and the rest of the group, it tends to be very strong. And so the fact that it's weaker is a problem. But this rise in interest rates, people are worried about the rise in mortgage rates, and that seems to be hurting the group. To be honest with you, though, I do think, even though it should come down a little bit further, it's going to provide a great opportunity for this group because, one of the great hedges for inflation are hard assets, including homes. I mean, during the 1970s, when we had even worse inflation situation, real estate, especially residential real estate, did very, very well. So I think that even though it's people are worried about mortgage rates really hurting, and it probably will hurt a little bit, but I think it's going to provide a great buying opportunity because of that hedge against inflation. So you don't want to be necessarily aggressive right here, but this is one group that I think is going to do a lot better than people think once they get a little bit more washed out.
And Matt, one supposed hedge or thought to be a hedge was Bitcoin against inflation, but that has really gotten blown up here. Any opportunity to start buying here around 40,000?
Yeah, one of the things, 40,000, that's kind of, that's the line in the sand. That's the level that we bounced very, very strongly off, just a few months ago, and it needs to hold that level. One thing I would warn against is some people are saying, are pointing out today that the 50-day moving average on Bitcoin is crossed below the 200-day moving average, and that is a death cross. It actually isn't a death cross. It has to be, you have to see both moving averages declining. The 200-day moving average is still rising for Bitcoin. So I'm kind of confident. I think the thing will hold 40,000. So it could be a way where you want to nibble a little bit more here, but you do have to be very careful because if it does break below 40,000, that momentum play is just going to be completely thrown out the window, and people are going to start thinking that it's going to drop quickly to 30,000. So like usual, if you're trading in the cryptocurrencies, you have to be very, very nimble. And the one thing, again, with the Fed pulling back, they didn't go from neutral to tightening. They went from massive stimulus programs to tightening. That hurts assets that were helped by their large S. One of those were crypto. So you need to be very, very careful, very nimble here. And you might still want to look at gold as an inflation a hedge on inflation. It's worked for 5,000 years. I can't imagine it's going to stop now.
Here with an outlook on the home builders for 2022 is Mark Fleming, chief economist at First American. Mark, thanks for being with us. I would like to get just your reaction to that surprise jump in home construction last month. And do you think that we're going to see that sustained momentum this year?
Yeah, I think obviously it's good news. The housing market writ large can never need enough new homes at this point. We have significant shortages of the housing stock. We've underbuilt for a number of years now. So the more, the merrier when it comes to home building. Not only was it good news this year, but we've seen, basically a 50-50 split in multifamily and single family homes under construction that are at paces not seen since the 1970s. So an impressive and good number, and more is needed.
What do you expect as far as home appreciation this year? Do you expect that to continue? And then do you expect to see more people being able to switch homes, or are they going to be locked into staying where they are because of higher costs?
Yeah, it's the simple supply and demand 101 dynamic that you were talking about in the last segment is playing out in the housing market as well. A shortage of supply relative to a lot of demand, largely driven by millennials aging into home ownership. And that's why we've seen so much house price appreciation in the past year. That's expected to continue. We might see some easing of supply inventory and maybe some reduction in demand as rates rise and affordability is curtailed a little bit. But the imbalance is so big that house prices are expected to continue to rise, albeit not at the same pace as last year. It's sort of the fundamentals of the market, and it's been that way for a number of years now.
We know that affordability continues to be an issue, and a big part of that is supply. We know that there are not enough homes on the market for the entry-level homeowner, those millennials that you're talking about. Did some of that home construction, I know it was fueled by multifamily projects, apartment buildings, but were builders busy building entry-level homes last month and last year, or was it more of the high-end luxury homes?
Historically, home builders have traditionally not even attempted to serve the lower end of the market. That's done through existing home sales of the smaller homes to entry buyers. But in the last couple of years, because of the dearth of homes for sale in the inventory on the existing side, home builders have done a much better job of also building at the lower end. But I think what's really interesting here is the relative share of multifamily, that we're still building so many multifamily units. And I think that largely gets to the fact that if you think about it, we all love shelter, whether we rent it as an apartment or own it as a home. If there's a shortage of homes or you can't find something to buy, then you're going to rent instead. And so that substitute good is playing out between the two segments, multifamily and for sale owned homes, because of the shortages.
And then we know rate hikes are coming, right? So what will higher mortgages do to demand and demand for home building? And what other macro risks are there in the year ahead?
Well, we've actually seen a significant move in mortgage rates in the last few weeks. In fact, we're already above 3.5%. But what's most interesting there in the mortgage application data that also came out today, even though rates have gone up, there's a big surge in purchase demand. We've all heard of the concept FOMO. Well, that's what's in play right now. People are rushing in saying, oh, my goodness, I can see that rates will clearly go up more in the year to come. And therefore, we're basically putting a lot of purchase demand now for fear of missing out on those low rates today.
We saw an analyst at KeyBank downgrade a number of the home builders today, citing those impending rate hikes and higher inflation. And typically, we do see home builder stocks pull back during cycles of tightening by the Federal Reserve. Do you think as the year goes on, business will get tougher for those home builders?
That may be true in a balanced supply market, but given the supply imbalances, I continue to see strong demand for both new and existing homes this year. That said, if we get major moves in mortgage rates well beyond 4 or even to 5%, which nobody is forecasting, that would be, we can handle gradual change in the market. It's much more difficult to handle sudden changes. That being said, there's no reason to believe that there'll be a sudden move in rates to significantly higher levels. And we have to keep in mind that while rates are going up, they're going up from, historically low levels to begin with. It wasn't too long ago that a 6% mortgage rate was considered phenomenally good. And all indication is it's unlikely we will be well below that, even though rates have risen by the end of this year.
Market. Here with his outlook is John Ziegler, CEO of RentPath. John, welcome to the show. 2 years ago, rent prices were at bargain basement prices. What has changed since then? And do you think that rent prices have peaked?
Yeah, well, thanks for having me. And you're right. Rent prices have continued to go up throughout the pandemic, and we're continuing to see that occur. Right now, vacancies are at an all-time low across rental properties across the U.S., and rental prices for 1-bedroom and 2-bedroom homes have gone up on average across the U.S. between 16 and 21%. There's two things going on. One is you've got a lot of folks that are maybe being pushed out of the housing market as housing prices have been increased. You also have a lot more demand for rental properties, and the supply of rental properties has not been where it has been. Now, there's a lot more coming online in the next year or so, but I think that we're probably going to stabilize here for a while, and we'll continue to see this.
John, renters are paying so much more. What are they prioritizing at this point? Is it lower pricing? Is it location? What are they looking for?
I think it depends on a lot of things, and some you can sort of see in the data. Some would be anecdotal. Potentially one of the reasons for the increased demand of rental properties as a result of the pandemic is, perhaps you used to be in a 3-bedroom with 2 roommates, and now you really want to have your own place because you're at home all the time and you want more privacy. I think that a lot of it demand is around location. So you do see markets where rental prices are up 40, 50%, and a few markets where they're flat or down a little bit. A lot on the coast, coastal towns have seen a lot of rise. So I think a lot of it has to do with location, as well as amenities, as people start to be able to work more freely, work from where they want to be. So they're moving based upon that versus maybe where the job is.
You know, John, the national eviction ban has lapsed, and now a lot of states are letting their eviction moratoriums expire. It happened recently in New York State, for example. What effect do you expect that to have on the rental market?
You know, we have not seen a huge, there's not probably been the huge flood of evictions that folks saw. That folks we were saying were going to come. I believe from the studies that we've seen, you've seen an increase in non-pay, as they would say. So that would be more of a pre-eviction action. But I think it really remains to be seen. We do have a very strong job market. You have a lot more jobs available than you have folks to fill them. Rates, pay rates have gone up significantly. So, one would hope that you're not going to see a significant increase in evictions because people are actually financially able to be, to continue to pay their rent, at least not above historical norms. We've been in a little bit of the last 24, 22 months have been, a different situation because you have had these moratoriums.
And John, as you see more people sort of migrating and sort of, they have the flexibility to move around for their jobs, are you seeing a rise in short-term rentals because people are just don't want to be tied in and they want that flexibility to get in and out quickly if they need to?
What we're seeing is a lot more property management companies enable more flexibility. So enable folks to be able to get out with less penalty, if they want to. I do think, and I failed to mention it, I think that want for flexibility is probably another reason for the increase in demand for rental properties. Because if I think I want to live in Denver for half the year and then I'm going to move to Miami or whatever, I'm not going to buy a home, right? I'm going to want to rent. I'm going to want the flexibility to move as I want to move around the country. And I think that also drives some of this demand. But I think what you will see is more flexibility in that, because that will become a sort of a key selling point for renters is, how long am I stuck? Can I move? And we've seen in a few cases where the property management companies have been able to charge a little bit more on the rent because they're giving more flexibility on the ability to get out early.
And I know that RentPath, John, was recently acquired by Redfin. Just curious what kind of growth your company has personally seen during this time and plans, maybe expansion plans here in the new year.
Sure. So, RentPath is actually started with Apartment Guide, if you remember that back in the day, but really created the category around being able to aggregate all the rental properties for one place for consumers to be able to find it. And our focus is really on two things, which is on helping people find a place called home, be that a single family home, an apartment, a condo, doesn't really matter to us, and do it simply and easily. And on the other side, to really help property managers and landlords fill vacancies efficiently and easily and lower friction and be more profitable. We've seen a lot of growth in demand in the last few months. Interestingly, you've had a situation where vacancies are so low that landlords have been less worried about filling vacancies. So the demand for certain things that we do has not been as high. I think we see that coming back right now. But you have much greater turnover of folks as they move around. And so that need is still there. Our goal really as we move forward is to continue to build out the suite of marketing and engagement services that we provide for property managers that make it easier for them to attract, engage, sign, and then manage those tenants in those properties.
Let's bring into the stream Dream Finders Homes Chairman and CEO, Patrick Zalupski. And it's good to have you here. Your stock went public a year ago. You are trading higher today. And you are in, what markets are you building in? I saw Denver, I think Jacksonville, Orlando, and Washington, D.C. Where else?
Thanks for having me, Adam. That's correct. We're in predominantly the Southeast in the markets you identified, as well as Texas. We completed a large acquisition in the 4 major Texas markets last year. And so that positions us well in one of the largest housing markets in the country.
Patrick, this is Emily here. Dream Finders Homes, of course, your company is one that creates, builds, and sells homes in these high growth markets. Can you tell us about where you're seeing some of the most demand and how these trends have changed over the course of the past 12 months?
I mean, we're seeing steady demand across all of our markets now. As you guys identified, we're in what we believe to be high growth southeastern markets, including Texas and Colorado. But it's been steady. We continue to remain bullish on housing. We think the cost inflation and some of the sort of tempered buying has been maybe a positive for home building, just to slow down the rapid appreciation we saw in the second quarter and third quarter of 2021. So, we're looking for a nice steady market where we can continue to take market share. And we sort of see that as the outlook over the next several years.
Remove the shade from the eyes of those of us who don't know your industry as well, especially when you look at millennials who might be, household formation. Which is going to be the bigger impact on them? Is it the price of the new home? Because we know that lumber prices, commodity prices going up. Or is it the interest rate? Because when you get to be someone who's Gen X, 3.5% interest is still in my mind, wow, because we were alive during those 15% interest rates.
That's right. To your point, rates are still historically low. I think it all factors in, right? Everything is a cost input, and it sort of, the output is what can a buyer afford. And so if rates go up, then maybe there's some adjustments in the buyer's decision where they have to be in maybe a few less upgrades in their home, a few less bells and whistles, or they have to be in a different community than they were expecting. Maybe they have to go a little further out to get a more affordable price versus an infill location. So all of those variables go into the equation. And, that's where Dream Finders, we think, is really strive to be successful, where we want to provide value no matter what the circumstances are. So our goal at the end of the day is just to provide great value to our customers. And so if rates are going up, we have to take that into effect. Or if costs are going up, we have to take that into effect. So it could mean a smaller home, or as I said, you may have to drive a little further out to maybe a little less desirable location.
For those who are considering perhaps building their own home rather than purchasing an existing home, what do you think the main factors are that some buyers should be considering when making that decision? And where have you seen people really falling in terms of whether to build their own home or purchase one that's already existing over the past year, just given the current market environment?
Sure. Well, clearly the resale market is significantly larger than the new construction. It's probably 80 to 85% of all homes sold every year are resale versus new construction. So we're a smaller segment of that. But there's a customer out there that wants to design it the way they want to have it. They want to pick out the options they want. We'll offer a high degree of customization, structural options, air quality systems. So there's a lot of benefits in technology that exist now in new construction that you just won't be able to achieve through a resale home in a lot of cases. So those are the benefits that we want to tout. But, we believe in home ownership. So whether it's new construction or resale, we like to see a robust housing market, and we want to grow the overall pie.
Is whether you're renting or even buying a house with mortgages, housing prices are high, mortgage rates are going up. Inez Ferre has been following what is going on in the housing market and what might still be coming at all of us. And Inez, what have you got for us?
Well, Adam, we're finding that inflation is still keeping these prices higher for homes. And if you take a look at the mortgage rates, which have been rising, you had last week Fannie Mae or Freddie Mac announcing the 30-year at 3.56%, up 11 basis points from the prior week. And you have the 15-year at 2.79%. So the mortgage rates have been rising, and those home buyers that were perhaps hoping that if the mortgage rates rise, then you you would see sort of a tapering off of prices or perhaps even a little bit of a relief on home prices. Well, they're still going up. And part of this, of course, has to do with the low inventory, but also part of this has to do with inflation. Keep in mind that in the 70s, early 80s, you had interest rates that were 15 to 18%, but you still had home prices going higher. As far as what the correlation is between mortgage rates and between prices, it's really between activity. So the activity in sales is expected to slow down a bit. But even so, I mean, Fannie Mae is saying that sale of existing homes in 2022 will slow down by 3.2%. That's still the second fastest annual pace since 2006. And as far as prices are concerned, Fannie Mae is expecting a rise of anywhere between 7 and 8% in prices this year. But that's on the conservative side, because you had Goldman Sachs last year predicting that this year you would see home prices go up by about 16%. So net, home buyers that have been sitting on the sidelines are now also trying to rush out to buy homes before the mortgage rates go higher. They're still seeing high prices for the homes.
Welcome back to Yahoo Finance Live. The expectation for a March rate hike from the Fed has led to a feeding frenzy in the housing market. So many potential home buyers looking to buy ahead of those hikes. Our next guest called the housing market peak back in 2008 and now says she's starting to see some warning signs in the market. Let's bring in Ivy Zellman, Zellman and Associates co-founder and CEO. Ivy, it's good to talk to you today. Talk to me about what you are seeing right now. It feels like there's a lot of FOMO that's setting in. How frothy do things look from your end?
Well, thank you for having me. Overall, the housing market has been accelerating and actually, which is hard to imagine because it was already pretty red hot. But because of the anticipated backup in mortgage rates, you do see a lot of fence sitters. It's usually 3 months that you'll see a pop in overall activity that then starts to diminish. But I think assuming rates go higher from here, we could see a pretty substantial slowing in the market that we're anticipating, not contingent on rates rising, but really the bigger factor we're worried about is the level of supply that's right now being governed by supply chain bottlenecks. But there's a massive backlog of both single family for sale, single family for rent, what we call build for rent, and there's a massive pipeline of multifamily that if all that product gets completed over the next year and a half, 2 years, we're going to have oversupply causing pressure on home prices. And that's aside from the risk that rates are going to go higher. But happy to drill in a little bit on the rate increase and what it will mean if you'd like.
Yeah, let's talk about that a bit, because if you think about where things stand right now, it kind of feels like the perfect storm. Number one, there's the concern about buying a home ahead of those rate hikes, but also inventory is just so low. So there's not a lot to buy. How much of that you think starts to balance out once we see that first rate hike in March?
Well, first you have to keep in mind that a lot of the momentum we're seeing incrementally is coming from non-primary buyers. And that is, a basket of investors that are private investors looking for diversity from the stock market, that plan on buying homes and renting them out, people that are, trying to create cash flow income. You also have cash flowing assets. You also have second home buyers, and you also have institutional capital, fix and flip investors, and what we call liquidity investors like the iBuyers. And they're competing right alongside the primary buyer, and in most cases upfront are using cash. So that momentum has been accelerating really the whole second half of the last 6 months of 2001 and accelerating into 2022. And so the primary buyer, if you recall, back in pre-COVID, inventories were at all-time tight levels. But home prices, a good year would be up 4%, like 19. So we went from 4% to up nearly 20%. And I think a lot of that was primary buyers in the market, a lot of who we pulled forward. But when we get to a mortgage rate, let's just say theoretically that we start to see a 30-year fixed mortgage rate as high as 4%, we have about 70% of homeowners in the United States that are already locked in below 4%. So if you're locked in at 3%, and rates are now 4%, it's a big disincentive to move. And we've seen this happen in the past. In 2018, mortgage rates went from 4 to 5 from the beginning of 18 to the end of 2018. They were at 5, and the housing market came to a screeching halt. You also have the risk of the wealth creation that we've had in the market, stock market, whether crypto, equities. A lot of people are attempting to diversify, taking money off the table and investing in residential real estate, and they plan on renting out those homes. So I think the mortgage rate increase will really hurt the primary buyer. Will it slow the investor is another story. That might have to wait for fundamentals to really be impacted by the incremental supply in the pipeline we see coming.
To what extent have the investors coming into the market pushed housing prices even higher? To your point, there's a lot of new wealth that's been created. There's number one, the investors who are coming in saying, look, if you consider just how choppy equities are, there's a better, more stable investment here in property. You've also got new wealth that's being created through crypto and other assets. How much has that, the increase of those buyers, how much have they pushed prices higher?
Well, to just give you some perspective, when you look at historically the trend line of renters that convert to home ownership, pre-pandemic for 3 years prior to the pandemic, it kind of ran about 2.3 million. And by the end of first quarter of 21, we got to over 2.8 million. Now that number has moderated back down to like 2.4 million. So when we look at the incremental demand, we know that that's coming from an investor that was, call it 21% of the market. That's now 26% of the market. And that's not necessarily including all the cash buyers that we're seeing. So I think to think about the surge in pricing, it's very difficult to quantify for you, but we know the impact is moderating renters relative to the peak are being offset by that momentum from the investors. So I would have to guess, if I was guessing to try to correlate the increase in home prices, I'd say it's a pretty substantial portion of the surge, at least within the dynamics that you're excluding the primary buyer. The second home buyer has also been a big part of this market in the last 2 years. And one would argue maybe the second home buyer is a little stickier because they might be truly looking for a vacation home long term. But do they start to get nervous if home prices are hitting a wall, they've made a ton of money, and they decide that they want to sell now and take their chips off the table because resi's slowing? So I don't know if that really answers your question, but I think it has been a disproportionate part of what has resulted in the surging home prices we're seeing.
So Ivy, what do you tell primary buyers who are looking right now who are saying, look, I kind of want to take my time a little more. I feel like I'm getting pressured to buy because those that first rate hike at least is coming. Is there, I don't know if value is the right word, but should they be waiting or should they rush in right now, even with low inventory, because waiting for those hikes and the price after those hikes will push things even higher?
Well, I'm a mother of 3, and I can tell you that if you need more space and your current situation, you're paying in rent what would arguably be more than what your monthly payment would be if you were to buy today, then I think you have to make a transition. But if you're not sort of in a have to move mode, then I wouldn't. Because when you look at first time buyers today, there's going to be a ton of product available coming. And, they call it the winter's coming. But, we have a backlog that's at 2007 highs in single family. If you go into the Southwest, Southeast, portions of the mountain states, the pipeline is massive. And when builders build all these homes, whether it's the for sale or the for rent even, there's gonna be a lot more choices. So I would be more patient unless you have to, because you're just busting at the seams and you can't get, your family is just too big for your home. And again, the monthly payment on a relative basis, rent versus own, should be how you're thinking about it.
Welcome back to Yahoo Finance. Well, home ownership has always been a part of the American dream, but for many minorities, including Blacks, the dream is becoming unaffordable. Here to shed more light on the topic, we are joined by Kristen Myers, the Balance Editor-in-Chief. Kristen, thanks so much for being here. And this is a great topic, so I'm so glad you came on to discuss it. So the latest census data show that white home ownership held pretty steady last year at about 74%. However, Black home ownership has seen a steady decline from the pandemic peak to about 43% at the end of last year. Why is that gap getting bigger?
Yeah, and one other thing to note there, Karina, is that this gap that's around 31 points right now is actually wider than the gap that existed 60 years ago in 1960 when it was 27 points. So why we're seeing this gap, or rather this decline, right now, I think probably a little bit of an impact from the pandemic. But also we have to say that this gap has existed again for 6 decades. It has been persistently wide. And I think really we have to look back in history for the answer to that. This is essentially just the cumulative and persistent and ongoing impact of, frankly, discriminatory policies that exist in the housing market.
Well, let's tick through some of the reasons why this is still happening all these years later. And the problems are very much the same as they were decades ago. Let's begin with redlining. How prevalent is that right now, and what has its impact continued to be on the Black community?
Yeah, so redlining doesn't exist in the open way that it existed in the 1930s, when it was an official policy of the banks to quite literally draw a red line around maps of areas where they were not going to give loans, or where only Black Americans or other minorities were essentially allowed to live. But we do see that there is segregation still to this day. It just doesn't happen as overtly as it once did, because redlining was essentially outlawed in 1960. But we still have studies to this day, even of agents sometimes, steering home buyers to certain areas that maybe have people that only look like them. So the effect of redlining still exists to this day, and it does still happen to this day, just not as openly as it once did.
Yeah, Kristen, my husband is African American, and he was looking to buy a home in St. Louis several years ago, and exactly the same thing happened to him, and he was directed in one direction when he made it very clear, because he's from there originally. No, this is not where I'm interested. I'm interested in another area. So it definitely does happen. You say the policy of urban renewal is a new threat to Black home ownership as well.
So urban renewal is something that actually has been going on for quite some time. And it essentially was a policy that allowed the government to raise and completely destroy a lot of Black neighborhoods in the name of, building a highway or putting in shops and malls and other amenities and centers. And we saw a lot of Black communities just be completely destroyed because of that. So, first you have a lot of these communities or a lot of African Americans, I should say, forced into certain areas, then creating, vibrant communities of culture, and then having those communities destroyed through this process of urban renewal. But a lot of what we are seeing now is a devaluation of assets that Black home buyers have. So a lot of folks, they do manage to purchase a home, and now they want to sell a home. And right now, is a really great time to go out there and sell a house. Homes are at record high prices. But when they go and get an appraisal, their home is worth far less than the homes that are owned by their white counterparts, sometimes next door or within their same neighborhood. And the cumulative impact of that is literally hundreds of billions of dollars of lost wealth that has been, in effect, stolen from the loss of the gains that could be made in that housing market, even once you do own that home.
So look, we know that home ownership is very closely tied to wealth and generational wealth. It remains a popular, way to increase wealth for all people in this country. What does this gap, what is the inability for a large number of the Black community to become first-time homeowners? How does that impact their overall wealth?
I'm really grateful that you asked that question, Alexis, because we have talked a lot about the racial wealth gap in the United States, how it has widened over time, how it has remained persistent despite, massive gains in the stock market, despite massive gains in the U.S. economy, right? Why does this racial wealth gap still exist? Well, the point is it's because of the home ownership gap that still exists. As you mentioned, home ownership still is the most popular, the most viable way that Americans can attain wealth. For most Americans, owning a home is going to be the largest asset that your family is going to have. So if you're first unable to purchase a home. And then even once you are able to purchase a home, your home is now worth less. That is real wealth that is being denied to you and your children and your grandchildren and your great-grandchildren, and on it goes. I mean, in 2019, homeowners had 40 times more wealth than that of renters. And that's just real cumulative losses that happens every single year. So if we want to tackle that racial wealth gap, we're going to have to start looking at that home ownership gap as well.
Prices here to discuss the outlook for this year and how it's impacted by economic conditions. Let's bring in our next guest, Doug Duncan, Fannie Mae chief economist. Doug, thanks so much for being here today. Just want to start by looking at that economic environment in which the housing industry, exists right now. So GDP grew at 5.7% last year, 6.9% in December. I'm wondering, how much growth do you envision seeing this year as inflation continues to run red hot, and where are we in the business cycle?
Yeah, sure. I think the message you got today in the bond market from the employment report saw the 10-year rise something like around 10 basis points, which suggests that the market thinks the Fed will be more aggressive, and that employment report suggests they have a rationale for doing that. So that our view is that the economy is already slowing, even though that fourth quarter number was strong. A lot of that was inventory building that was taken out of the first 2 quarters of next year. So we think somewhere between 2 3/4 and 3% growth next year, which is still a good year, but it will be a year in which the Fed is tightening. For housing, we characterize this as a pivot. Several things are changing. First of all of the income transfers from the stimulus are over, so that's going to be withdrawn as a growth driver. The Fed is obviously changing posture. So monetary tightening is going to be the story, not monetary easing. That suggests that rates are going to rise. And for the mortgage space, the fact that the Fed has said eventually they would like to have a portfolio with no mortgage-backed securities in it, and that they intend probably around mid-year this year to start running off the holdings that they have in the portfolio, it means they're expecting private investors to step in and replace the Fed, and they may well require some additional yield. You've already seen some run up in interest rates. That will be paired with, while slower price appreciation, still price appreciation in 2022. Those two things at the margin will offer some constraints, particularly for first-time homebuyers.
And so the Fed is expected to start hiking rates in March. And I'm wondering, how does that impact home buying, as mortgage rates already have started to climb, but obviously will start climbing more?
Yeah, to the extent that that rates continue to move up as the Fed takes additional actions, that will, as I said, particularly impact first-time homebuyers. Now, there is a cushion that suggests that this won't go too far, even if rates, say, break 4% by the end of the year. And that is, while savings rates have fallen back to pre-pandemic levels, the dollars that households have in their checking accounts are about $2 trillion more than what the pre-pandemic trend line would suggest. So the consumers still have some money, and some of that will get applied in the housing space. The other challenge, however, is even if you want to buy a house, supplies are so low on the existing home side, it may be hard to find one.
Yeah, absolutely. And home values have soared over the last year, something between 15 and 17%, creating vast amounts of housing wealth. Low rates are locked in. So how much appreciation do we see this year? And then what incentive really is there for someone to sell? Because, your home is worth much more, but to replace that is very difficult.
Yeah, that's a challenge. We saw something on the order of 18% increase in house prices in 2021, following about a 15% increase in 2020. Our estimate is that in 2022, the increase in prices will be somewhere in the 7 to 8% range. It sounds sort of funny to say way down to 7 or 8, which is much higher than the long-term average. It is the problem for an existing homeowner that if you're going to sell your house, you have to find another one. And my favorite anecdote recently is basically every realtor in the country has one house to sell. There are about as many houses available for sale as there are realtors. So that's the challenge, is you may have equity in your existing home, and certainly do, given the price appreciation, but finding another house, you may well give it away to the next owner if you make that shift.
So it's been a tale of two cities, right? For those who have the money and can invest, it's been a great opportunity to buy. And some of those people buying are second-time buyers or they're investors. But what about for the first-time home owner that just can't afford these prices? They're really being priced out of the market. They're having to go to the rental market. Those prices are going higher and higher. It's a housing crisis, if you will. And what do those people do? What's their recourse?
Well, the big challenge for first-timers has been that there were a lot of cash buyers in the market. So it's faster to close the sale of a home with someone who brings cash to the table because you don't have to go through the financing mechanism. So that's been the biggest challenge for the first-time buyer. That will get easier. That is, there will be less cash coming to the table, less bids over price, but still the demographics suggest we're not near the peak of millennial home buying yet, so there's going to be additional pressure on the demand side, even though we do expect a bit of a slowdown in sales this year, primarily driven by those two factors of declining affordability and the lack of affordable supply.
And really quickly, just want to ask you, do you see any relief in the rental market coming later on this year?
Well, the rental market actually has a lot of the same characteristics as the purchase market, which is strong demographic demand. The rent appreciation did take a bit of a hit at the beginning of the pandemic. However, it has recovered and is on an upward profile again. So the renters will suffer some of the same issues as buyers are, which is appreciating prices, in this case, appreciating rents. And of course, all that shows up in inflation measures, which is one of the reasons that nominal interest rates are going to rise.
Let's stay on markets right now and bring in our guest, Debbie Boyd, DLB Financial Services CEO. Debbie, thanks so much for being here. I want to start by reminding you the last time you were on with us and spoke to us in October, you had a quote, and I want to tell you what it is. You said, "Did we think it would stay this low forever?" I think people are in denial about how the markets work, talking about rate hikes, of course. So do you think the denial is now over? Markets pricing in between 5, maybe even 6 rate hikes to come. Investors are getting whiplash between all the analysts, between bearish and bullish calls. Where do you stand?
Well, I'm a mortgage broker by trade, so I do believe the Fed is going to raise rates. We've already seen almost a point raise since the end of December. So I've got people buying homes that when they first came to me and they were just, quote, looking, I was giving them rates in the 3.5 range. Well, now that's pushing 4. It's been up, it's been down. This is the new normal. And what I think people need to figure out is that things aren't going back down. We're very happy that our homes have gained all this equity in the last year. And that means that property taxes are going up. That also means that interest rates can handle it. There is a demand. So we have to quit thinking this is a bubble and just start thinking that this is it now. This is the real thing.
So do you think that we see as many as 5 or 6 rate hikes, or do you think that inflation does come under control at some point during the year and maybe the Fed doesn't need to be as hawkish and will, step back?
I wish everybody would just leave the market to do what the market does, but that's not the case. So I think we're going to have 3, maybe 4 hikes this year. Doesn't mean they're all going to be huge, but even 1/8 of a point or 1/4 of a point does trickle down through the markets, and it makes everybody nervous. Now, is that going to slow down housing? No, because if you need a new house, you're going to go buy a house. If you're moving across the country and have to relocate, you're going to be buying a house. It doesn't matter what the price is. We are used to now historically low interest rates. I remember when I got a 5.5 rate several years ago, like 10 years ago, and that was a great rate. So it's all in what we're used to. We've forgotten that rates were higher than 2% at one time.
Yeah, you're exactly right there. I want to turn your attention to then how should investors be positioning themselves right now in an environment where, tightening policy, we're seeing these rate hikes, volatility is still there. Is it a time to sort of sit back and remember cash is king and maybe sit out a little bit for things to calm down a little bit? Or is it the right time to sort of jump in selectively? And if so, where do you suggest looking?
There are still going to be homes available to buy, and people are still going to need to move. So whether people get priced out of the market and they need a rental property, now's a great time to buy. Interest rates are as low as they're going to go. They're not going back down. So if you want to get into the rental market, now's a great time. It's just like when you need to buy a car, you buy a car. If yours is dead, you need a new one. It doesn't matter what the interest rates are. You're going to get the best deal you can. So investors, yes, and now's a great time to buy property. Values are up, but they're going to stay up. That's what we wanted. So you're going to be buying a little bit more expensive with a little more expensive money, but it's not going to get cheaper. So if this is the market you want to get in, you need to get in now.
And then earnings, blockbuster earnings coming out this week. We're going to see Coca-Cola, Pepsi-Cola, Chipotle tomorrow. Kellogg's as well goes right to the heart of the consumer and inflation. What are you most concerned about? What are you looking for as earnings do come out?
Well, I do think that we have to think about how we spend money and what we buy. So when a family starts to tighten their belt, they're going to buy food, but are they going to be going out for food? That's going to be the question. And if so, what kind of food are they going to buy? They're going to buy cost-effective food. So if Chipotle is still going to be easy to order online, it's very convenient. There is a demographic that is going to keep buying that. As families see the cost of everything go up, housing, gas, we're going to see not a lot of job pay increases, and we're going to see inflation go up with your groceries. People are going to clamp down. So are they going to be going out as much? Probably no. And then I think it's good news for the streaming services, Disney Plus, Netflix. People are going to be staying home more than going out. Ticket prices at theaters are also going up. So you just have to think of what is the most cost-effective way. If I'm a family and spending money, where can I get my best bang for the buck? And those are going to be the stocks to look for.
And then as far as sectors that you like, I know the last time you came on, you were quite bullish on airlines back in October. Do you still feel that way? What about financials? And you said you like energy as well.
Sure. So when we talk about airlines, there's a big merger coming on with Frontier and Spirit. I think a lot of companies, we talked before in the last break about Peloton's going to be maybe looked at by some different suitors. Now is the time for a lot of companies to, I guess, re-transform themselves into something else that they think is going to be advantageous moving forward. So yes, airlines, we're still going to airline travel, but is this good for consumers? Sure. If we can get reliable air carriers at an affordable price with some options, it's going to be a great thing for consumers. So I'm looking at it like that. Energy prices are going to go up. Food prices are going to go up. So we just have to be prepared for that. I know the orange market had a tough time in Florida this year. Orange juice is going to be super expensive. So you're going to see consumers looking at different products just to fill the gap in their grocery budget.
And then finally, what do you think about big tech as a sector to invest in now? Because the NASDAQ is down more than 13%, almost 14% from a recent peak. So is this the time to sort of go through and cherry pick, or do you stay away from those growth names for right now, at least?
I am going to invest in tech because, as you see, people are changing jobs and they're going to jobs that are tech heavy. So am I really in the mortgage business, or am I in the technology business of getting your loan done as quick as possible? So tech helps me. If tech helps your company, which it helps almost every company right now, you've got to be invested in tech. I think it's always a good idea.
For more on what that means for home buyers and owners is Yahoo Finance's Jana Herron. Jana?
Hi, Alexis. Thanks for having me.
So what is it? First, tell us first off where these rates even are at the moment. I know the 30-year well above 3%.
Yes, we hit 3.69%. That's up from 3.55% last week. And it's really more than a half point higher than the end of December. So mortgage rates have really been on the move since the end of 2021. And unfortunately, this is not really good news for either home buyers or homeowners. So if we start with homeowners, the last 2 years really have seen some incredibly low, historically low actually, mortgage rates, and it's been a fantastic time for homeowners to refinance and lock in a lower rate and get a better mortgage payment. But that window now is closing very, very fast. So if you're a homeowner who's been sitting on the sidelines thinking about refinancing, that time is now if it hasn't passed you by already. And then for home buyers, gosh, it's such a brutal time to try to buy a house right now, especially for those first-time home buyers. They're already dealing with a really low inventory of homes for sale. There's double-digit home price growth. And now here's like the third whammy, rising mortgage rates. So houses are becoming even more unaffordable for those first-time home buyers. One statistic that really stuck out to me is that the average monthly mortgage payment for a median priced home is $350 more a month now than the same time last year. So you can really see how mortgage rates have moved and how this is actually not such good news for homeowners or home buyers.
Yeah, it is absolutely brutal for first-time homeowners looking to jump into the housing market. Bayan, I want to ask you, based on this red-hot inflation data that we got today, is it likely, it's probably likely, right, that rates will move even higher?
Yeah, so I hate to bring even more bad news, but yes, rates are likely to move higher. Fixed mortgage rates tend to follow the yield on the 10-year Treasury, which you guys were just saying jumped to over 2% this morning after that inflation report. So you should see mortgage rates also follow that in next week's report. Housing economists that I have spoken to expect mortgage rates to hit about 4% by the second half of this year. So I don't want to leave everyone on a very sour note about mortgage rates, because 4%, if you look at it over a historical time period, is not that bad. It's actually pretty good. Just ask your parents or your grandparents. They can tell you about the early 1980s when inflation was jumping just like it is now, and mortgage rates were at 15 or 16%. So if you end up getting that 4% rate, it's really not that bad.
This morning, existing home sales came in much higher than expected, in fact, reaching the highest level in a year at a seasonally adjusted annualized rate of 6.5 million. That was good for a 6.7% month-over-month increase. Now, on the heels of that, the S&P 500 real estate sector, as you can see on the screen, is still lower on the day, but also off session lows and also outperforming the broader S&P 500. Now, for the year to date, however, the sector is still the worst performer after communication services, with prospects of higher interest rates weighing on many real estate stocks. But taking a look at two home builders specifically, we are seeing shares of KB Home as well as Toll Brothers coming well off session lows. Toll Brothers shares have actually now turned positive. So one part of the market that we're continuing to watch closely is that real estate sector.
Lots of data there. We know that existing home sales jumped 6.7% in January to a seasonally adjusted annual rate of 6.5 million. Now, this also comes amid record low inventory, with homes often getting snatched up in a day or two and leaving less affluent buyers out in the cold. Well, to break down what's happening with the housing market, let's welcome Hassam Naji, Marcus and Millichap's CEO. Thank you for joining me.
Thanks for having me on the program.
So I want to first start by getting your reaction to some of this data. Obviously, looking at this 6.7% surge in existing home sales, median existing home prices up 15.4% on the year to 350,000. In this competitive market, though, what opportunities do you see?
Well, first of all, the number is not surprising given the trends that we've seen over the last year, in that the housing market has had a supply shortage. Unlike the 2008-2009 crisis, where over-speculation had actually created a vast majority of the credit problems that led to that downturn and a recession, real estate on this side of the cycle has actually been a contributor, and there's been no oversupply in housing or in commercial real estate. And of course, the effect of the pandemic has created so much demand for people to work from home, expand their living spaces, and so on. We're seeing the same phenomenon carry out in apartment rentals, which are also registering record demand and rent growth. So where does it go from here? We do have some concerns in that affordability is becoming an issue. Less and less people will be able to afford the 16% price increase that you just mentioned on a year-over-year basis. On top of that, as interest rates go up, of course, that affordability becomes even more acute. But the supply side of the equation is still constrained by the supply chain issues, labor costs, and so on. So again, supply demand is going to be fairly balanced. We don't expect prices to continue increasing for the for sale market at the same rate they have been. So some cooling off of prices. But nonetheless, the market is fairly stable. On the commercial real estate side of the equation, because of low interest rates and the fact that commercial real estate as an investment vehicle has always been viewed strongly as an inflation hedge, we continue to see record demand from investors wanting to invest in apartments, office buildings even, shopping centers, and self-storage assets, every category of commercial real estate.
So then as we talk about the Fed here, you said that a significant rapid increase in interest rates by the Fed could weigh on commercial real estate investment. What sectors are the most exposed, and how are you advising your clients to really brace for potentially 4 to 7 rate hikes this year?
Well, first and foremost, you have to remember the 10-year Treasury yield has already ran up quite a bit this year, and the market has adjusted fairly well. Lender spreads have come in, and what's really important for commercial real estate investments and valuations is the pace by which interest rate increases are met with rent growth increases. If the income and occupancy of these assets are healthy and growing at least the same pace, if not faster, than the rate of increases in interest rates or the cost of debt, valuations are well supported. So far, that's what we're seeing. The biggest risk is if the Fed goes too far too fast or has to react even more aggressively than anticipated to basically fight inflation. And I think we need some time to see if that's going to be necessary or not. Let's not forget that we're coming off of a significant recovery in jobs last year. Now the pace of job growth is slowing. Therefore, wage growth should probably begin to crest a bit. And the supply chain at some point is going to start easing again. So it's not a foregone conclusion that the Fed will have to really overplay its hand.
Now, I want to talk more about commercial real estate and really the record-breaking amount of investment we saw last year. Investors bought more commercial real estate in 2021 than ever before, and a record $335 billion just into apartments across the United States last year. But then you also have renters who want to become first-time buyers because the rents are increasing and a lot of leases are coming to an end. So what is your outlook for the apartment market in 2022? And what are some of the headwinds that you're watching for?
The outlook for apartments is quite robust because, as I mentioned earlier, the for sale housing affordability issue is going to become more of a problem. If you look at some of the metros like Austin or Salt Lake City, Phoenix, Los Angeles, even San Jose, the Inland Empire here in Southern California, they've registered price increases of 19, 18 to 28% on a year-over-year basis. A lot of consumers are going to get priced out of the for sale housing market and will have to continue renting. And a lot of consumers we've seen over the last 5 years, pre-pandemic, really were choosing to be renters to have the flexibility in the lifestyle that they've enjoyed as renters. And the apartment development community has responded by building product that the 30-somethings, 40-somethings, couples without children, or empty nesters really want to rent. Those trends have captured more renters than ever before. And for those reasons, the outlook for apartments is quite robust for 2022 and beyond.
And speaking of trends, we're seeing obviously Omicron-related COVID rates continuing to fall in the US. We're seeing a return to either in-person work or some sort of hybrid work from home in-person model. What are you watching for in the office market? And what are you seeing with the best and worst performing markets for vacancies?
The office market still has a lot of cloud over it, especially in urban America, where the vacancy rates are still very high. And of course, the pandemic affected urban markets much more severely than suburban markets. And the outmigration that we've seen was happening even before the pandemic. The millennials that were really fueling the demand for urban housing and professional service jobs, office jobs, were beginning to enter their 30s, forming families. 60% of them are now in their 30s, and they were already moving to the suburbs before the pandemic. And the pandemic, of course, accelerated that trend. So the office outlook is somewhat mixed in that you still have leases on average in place where the tenant has to pay the rent for another 4 years. So we have plenty of time for there to be a recovery in demand. But public transportation, getting people comfortable to come back into the office is going to take some time. We believe it'll happen over time, but the hybrid solution, workplace solution, is here to stay. We're experiencing it. Every one of our clients in some way is experiencing it. So it will reduce office space demand. But let's not forget that places like New York, Los Angeles, were the leading job creators in the last 12 months. 300,000 jobs in LA, 200,000+ jobs in New York. Dallas was the third largest job creator. So the urban markets are beginning to come back. And I think business formations that we're seeing at record levels will eventually bring new demand to the office market, but it's going to be a bit of a transition time. We're seeing a lot of opportunistic investors take advantage of office right now being the diamond in the rough.
Stories of people trying to buy houses but taking the L after getting outbid time and time again are no longer unusual. This as total mortgage applications dropped 13.1%. That's the lowest level since December of 2019. And to make things worse, we're about to hit the spring, which is a hot time historically for buying. So for more on this, let's bring in Vera Gibbons, Yahoo Finance contributor. It's a really tough market out there for people looking to buy a home, right?
Yes. And you said it's going to be a hot buying season. It's going to be sizzling hot. If you look at the estimates or the projections from Zillow, despite all of the challenges, so you've got mortgage rates rising. They're now at about 4%, which is the highest they've been since the summer of 2019. You've got very little supply. You've got a lot of people looking at what is out there, a lot of competitive offers, people outbidding one another. So very challenging conditions. And also, $1 million homes are quickly becoming the norm at the fastest pace ever. According to Zillow, 146 new cities became $1 million cities in 2021. They haven't seen those numbers ever. So you've got a lot of these challenges out there, but people are still pretty anxious to buy, especially those must-buy types, people who need a place to live.
I mean, Vera, I always appreciate our chats, but I walk away so depressed about the housing market. Seeing where inventory is in comparison to where demand is. Obviously, we're looking at mortgage applications today. The expectation has been with rising rates, maybe home buyers or those who are potential home buyers kind of pull back and say, maybe this is not the good time to buy a house. Have we already seen that slowdown? What are you hearing in terms of the hottest markets?
Well, I've spoken to some would-be buyers, and these are people who were interested in buying a house, but they don't have to buy a house. They already have a house, but they're thinking maybe they want to upsize, maybe they want to downsize, whatever the case may be. They're taking a bit of a break. I spoke to a bunch of people who have been looking sort of on and off for a while now. They've made competitive offers. They've been outbid over and over again, and they're getting tired of it, especially since they have become, involved in the whole process and fallen in love with the homes, and then they don't get it. So they're tired of the disappointment, and they've taken a back seat. But the people who are actually setting the market are, as I mentioned to Brian, those must-buy types, which is what one broker referred to them as. These people need shelter. Their rents have gone up too high, too much, 20%, 30%. In some markets like New York, rents are up by 50% in some markets, some pockets of neighborhoods there. So the rents have gotten too high. They've been evicted. They want a bigger house. They move maybe. There's a lot of movement out there. So these are the people who are those must-buy types. And they're going to great lengths to actually get the house they want. They're making these incredible offers, all cash in some cases. They're going $100,000 over asking in some cases, $150,000 over asking in some cases, and they're outbidding the people who would like to buy, but don't want to compete at that level.
So, what are the options for the people that need to find a place now? Is it they have to compromise? They have to look at different areas, look for something cheaper, knowing that they're going to have to bid maybe $100K over just to get what they want?
That's sort of what's going on here in this Florida market. I spoke to one person who was looking pretty seriously in Jupiter Farms area. She looked for 6 months, couldn't find anything that was within her price parameters. So she broadened her search, and she found something in Palm City, less expensive, not exactly her dream house. She likes it but doesn't love it. Even so, she made an offer, sight unseen. She made a blind offer. She waived the inspection to get the deal done, and she actually got the house. One broker told me in this market, you might get 50% of what you want. In a normal market, you probably got 85%. So people are having to lower their expectations and make all sorts of compromises to get the house. One broker told me the big win of the deal is actually getting a house. So the woman who I spoke to who is in Palm City now is thrilled as can be. even though it isn't her dream house, she's just very happy to be a homeowner because she went through all sorts of hoops to actually find a house that was affordable and that was available. She didn't have to go 10, 20, 30, 40, $100,000 over asking. She got it at a price that she considered reasonable.
Vera, I feel like it always comes back down to the key question here for those who are looking to buy a home. And what do you do with all of those factors you just highlighted? What's the advice for home buyers?
I think you just need to sort of lower your expectations and make those compromises. As I mentioned, you're going to get some of what you want, maybe not all of what you want. And as I mentioned earlier, too, like people who don't have to buy, they're saying forget about it. But the people who want to buy or who need to buy because, as I mentioned, their rents may be too high or for some other reason, they're, making pretty solid offers, and they're at a point where they feel like they've got to go 10, 20, 30,000 over asking, if not significantly more than that. And they are waiving the inspections, and they are making these offers no contingency. So this is the group that's actually winning. But again, there's so many people that just don't want to go head to head with these guys, and they're taking a back seat.
Well, record low inventory has sparked bidding wars for homes in some of the country's hottest housing markets. If you're looking for a dream home now, turnkey property, getting inside one could prove to be even more elusive. Let's bring in Yahoo Finance contributor Vera Gibbons. Vera, talk to me about this because I think the definition of a dream home could be different depending on the person, but you're talking specifically about this millennial group, younger buyers who are now going in saying, it's my first home, but I don't want a starter home.
That's exactly what's happening. So people who have been living in starter homes, they've maybe been there 3, 5, 7 years. They've built up equity over the years, and they're now hypothetically looking to buy a larger home and take some of those profits off the table, maybe find something more permanent. They're entering the market and saying, wait a minute, what's all this competition? This is millennials I'm competing with now. So millennials are bypassing the traditional starter home, which is generally a fixer-upper, needs a lot of work, new electrical, new plumbing, the whole 9 yards. And they're saying, you know what? No, I want the turnkey property. I want something shiny and new. So the people who have already been in these starter homes and are looking to get out are saying, where did this competition come from? And who are these people? It's millennials, which now account for about 37% of home buyers nationally.
And I think that word turnkey really applies to the millennial generation when I think about all the new products and services that have arisen over the last 10 years. I'm just wondering, what kinds of other things are they looking for when it's coming to buying a new home?
Well, they want space. Obviously, our lifestyles have changed over the course of the pandemic or because of the pandemic. We're all working from home, so they want a lot of space. You know, the traditional starter home, you think of maybe being 1,000 square feet or 1,500 square feet. Some of these millennials are going for 2,500 square feet, 3,000 square feet. I spoke to one couple that's engaged to be married, and they've arranged it so the woman works on the ground floor. He's got the entire second floor to himself. They have plenty of space, so they are both working from home. They also have a dog, so they've got lots of outdoor space. The dog likes to run around and play. So they have pretty much what they want for their current lifestyle needs. And then they're thinking ahead toward their future needs. At some point, they might want children. So they went ahead and bought like a 3 or 4 bedroom townhouse. Unlike traditional couples who might be, decades ago would be like, oh, let's get like a little 1 bedroom, maybe 1,000 square feet. They're just thinking, the millennials now are thinking, what do I need now and what might I need down the line? And they can actually afford to do this because of a combination of a couple of different things: low down payments, low interest rates, and buckets of money. Keep in mind that a lot of the millennials, young adults, they moved in with their parents during the pandemic. They weren't paying rent. They weren't making student loan payments. Many of these millennials are still living with their parents as they house hunt. So they have buckets of cash, which allows them greater flexibility to buy those more expensive properties. And their changes have completely changed. They don't want to roll up their sleeves and get new electrical, new plumbing, make all these crazy repairs. They like shiny and new, and they like a lot of space.
I wonder how much of this also, Vera, has to do with those, who are getting into homes later. So yes, we're talking about millennials, a younger demographic for home buying, but I'd imagine some of those couples that you spoke to, well, they've had the experience of renting for quite some time. They've had time to think about this. In addition to that, they've really had to think about it during the pandemic.
Yes, that's another factor that's playing into this as well. Also, keep in mind that there's not a whole lot of inventory out there. I mean, a lot of the original starter homes have been converted to rental properties, and the millennials don't want to pay any more rent now because the rents are becoming ridiculous. So that's definitely a factor too. It's a lifestyle thing, it's a demographic thing, and it is a pandemic-related change. So where we all go from here, nobody really knows. I spoke to one housing expert who says, well, once inventory comes back online, maybe we'll go back to our more traditional home buying experience. But he also said in the next breath, look, I've been watching the industry for 25 years, and I've never seen this type of activity. So like a lot of facets of our life, we're in uncharted territory.
Activity. Brad Smith here with Rochelle Akufo and Dave Briggs. And just as we've seen the markets close, let's also bring in our panel for today. We've got Lenore Hawkins, who is the chief macro strategist over at Tematica Research, as well as Jim Caron, who is the fixed income portfolio manager over at Morgan Stanley Investment Management. Great to have you both here with us today. I want to dive right into it, Lenore, particularly the housing market. If we can begin there, because you're talking about some of the flashing warning signs that we should be paying close attention to. We do know that home sales dropped, existing home sales, by 7.2% in February. Why should we be paying close attention to this measurement?
Well, that was a 6-month low, and every single region actually was posting declines. And the median home price, while it rose 2.1% month over month in February, what we're seeing is that home prices consistently are getting so out ahead of the ability to purchase them, right? When we see wages not keeping up with the pace of the growth in home prices, there's something to worry about. We've actually seen the year over year trend in the Case-Shiller 20 City Home Price Index has topped over the peak we saw back in the mid-late 2000s. That last housing bubble, we're getting an even bigger bubble this time. So the big concern really is that affordability has dropped towards levels that were last seen at the end of the last Fed tightening cycle. And think about what that means. At the end of the last Fed tightening cycle, that meant at the end of the increase in rates. And right now we are just starting to increase rates. So as rates go up, that means it becomes even less affordable, right? Because your mortgage is more expensive. And that's probably why we're seeing now just about 29% of sales are going to first-time home buyers. And normally home prices outstrip inflation by roughly 2 to 3 percentage points. Today, they're going at 11 percentage points above the rate of inflation. I mean, that's just crazy. Home prices are running at nearly triple the pace of wage growth. Simply not sustainable. And then as we look forward to what's being built, we see single family housing starts are up almost 14% year over year, while sales of single family housing is down 2.2% year over year. That indicates kind of a reversal that's probably on the way. And lastly, the ratio of starts to sales. Now that tells you what's happening today versus what we can expect in the future is nearing the levels that we last saw in the summer of 2007. And I think most of us remember what happened right after that.
Yikes. Let's hope that is not a repeat on the way. Very little inventory out there. Hopefully we'll keep those numbers up. Jim, I want to ask you about the big stock story of the day. Of course, Elon Musk, 9% control of Twitter, sending Twitter up 28%. What's he up to, and are you buying Twitter?
Well, I mean, I look at the fixed income markets primarily, so I'm not buying Twitter in any of our portfolios at all. But it certainly is it is a meaningful story, though. That's for sure. It's eye-catching.
And Lenore, I want to bring you in here, as we obviously have seen a range of predictions when it comes to recession fears. What is your prediction, and how should people be really balancing their portfolios at this time to manage that?
Well, we've got a lot of warning signs. Speaking of the bond market, over the past year, we've seen an acceleration in Fed rate hike expectations. Obviously, they keep talking about it. We see rising inflation expectations. We just got that again out of the Michigan Consumer Sentiment Index. And we're seeing an actual decline in real rates. And on Friday, we saw the 2-year rate, the 2-year Treasury go above the 10-year. It's the first time that's happened in quite a while. That's also a signal when the yield curve inverts. That's another warning signal. It's not a timing one, so don't think that that means a recession is imminent. But what it is it points to where we
we are in the cycle. And it's basically saying we're kind of in like the 8th inning of the cycle. And back to seeing the accelerating rate hike expectations, rising inflation expectations, and declining real rates, that really doesn't happen very often. That occurs less than 4% of the time, going back about 2.5 decades. And historically, equities following this have seen below average returns. And at 2 of the last times that we saw these 3 things happen together, there was actually a recession. So for investors under these conditions, what works best has historically been those kinds of defensive real estate, utilities, consumer staples, and healthcare. And those are actually what we've also seen outperforming year to date, the more cyclical things like industrials, consumer discretionary, financials, and materials. And then when we're thinking about a recession, don't forget the magnitude of what is going over in Europe with the war. We've already got enormous price pressure on food and energy, and that accounts for about 22% of consumer spending. So you've had a huge increase in those 2 things. And that means basically it's a big tax on the consumer's wallet, right? There's less left over for discretionary things. And now this war is, while the headlines are kind of talking a little bit like it's maybe getting less severe, what happened over the weekend, I think that's only going to put more pressure on as the Russian troops were retreating from some areas, finding what looks to be potentially indications of some very serious war crimes. That is putting additional pressure on Europe to really cut its consumption of Russian energy, and that is going to be brutal to do. Overall, while in the U.S., like our imports and exports to Russia are not that big, for Europe, it's a very, very big number. And that, you put that all together, that is just more pressure on pocketbooks.
And so that's a significant point, Lenore. Jim, with that in mind, when do you believe it would start to show up in some of the economic data if we did see U.S. companies most heavily impacted by any type of consumer movement in Europe as a result of the international conflict and the rise in prices that they're seeing? When would that show up in the data on some of the U.S.-based companies that are most dependent in their growth and even in their employment, and seeing revenue that they can pass through and see profits that ultimately helps out with their employment and so forth? When would that show up in the data here in the U.S.?
Well, there's a couple things. I think the first thing is that we're going to look at the global PMIs or the ISMs, the purchasing manager surveys. And what we're already starting to see is that things are starting to cool, even on a global basis. But we're not at levels yet that are sounding alarm bells. It's just that some of the overheating is starting to come down a little bit. And I think that's probably okay. And it's by design. I mean, the Fed is hiking interest rates. The ECB is thinking about it. The Bank of England is doing it. So it's okay in the sense that it hopefully will control inflation and rein in inflation risks. But the other thing that we have to focus on quite a bit, and I always think about things in terms of cash flow, free cash flow in particular, is that if earnings expectations start to come down, if we start to see revisions, meaningful revisions downward in terms of earnings, that would match essentially and be highly correlated with GDP expectations also coming down, so economic growth expectations coming down. That's when I think that we start to think about seeing a more protracted type of a slowdown. It doesn't necessarily mean that we have a recession. What it really just means is that we have economic activity that starts to decline, and it'll probably show up in earnings. Obviously, margins is a big issue as well. One of the things that's kept the equity markets relatively bolstered has been that profit margins have been wide. Companies have been able to pass through higher prices. To the extent that that starts to wane and that starts to falter, these are the cracks that we're starting to look for. They're not necessarily fully there yet, although we are seeing these signs start to appear. It's just not at a critical point. And I think that the real measure that we have to focus on here is what's happening with inflation, because that's really going to be what guides policy, and that's going to give us information as to what the Fed may do, how aggressive they may be, and that obviously feeds into earnings and margins and everything else.
Jim, how aggressive do you think the Fed will be in the next 2 meetings, and do you see a soft landing for the economy?
Yeah, so I think the Fed's going to be pretty aggressive. I think they're going to do 50 basis points in May and 50 basis points in June. I think the Fed is willing to risk a soft landing in order to rein in inflation risks. And I think this is one of the biggest changes in their policy reaction function, is that they're no longer as concerned with the unemployment rate, or they're no longer as concerned with growth. You know, they think that the jobs market is plenty strong, and they think that the economy is still reasonably strong, that it can withstand multiple rate hikes going forward. So I think the policy reaction function from the Fed, meaning what they will do, is that they are willing to risk not only a hard landing, but they may even be willing to risk a recession at some point. And maybe that's in 2023 or 2024, or maybe it's further away from that. But they're willing to risk it in order to get inflation under control, because they believe that if inflation runs out of control, that they're just going to have to do more later, and that creates a deeper slowdown later. So you might as well take your medicine now.
And Lenore, do you agree in terms of the level of concern, considering how much is within the Fed's control and outside of it when it comes to interest rates and policy tightening versus, say, some unexpected events or fallout from the Russia-Ukraine crisis?
I totally agree that the Fed is likely to be quite aggressive. I mean, we're even hearing doves like Mary Daly over the weekend talking about a 50 basis point rate hike. So I think they are going to be really aggressive. They tend to be behind the curve, and they tend to never really be successful in that soft landing. I'm not sure what choices they have right now, but it's one of the challenges we have when we talk about inflation, because inflation means a lot of things. Right now, what we're dealing with is prices are high because energy costs have gone through the roof. And that is the cost of moving things around. Energy is the core of everything in an economy. But it's going to be really tough for them to manage this, because while we keep hearing how the economy is doing really well, real disposable personal income has contracted now for 7 consecutive months. The last time we saw 7 consecutive months of declines was from December of 73 to June of 1974. So this isn't a typical kind of things to do. And real after-tax incomes have dropped at an utterly epic pace of nearly 5% annually. We still haven't recovered all the pandemic job losses. So we're still about 1.2 million below where we were back before the pandemic started. So that hot job market, maybe not exactly everything that we're hearing it is. And yet the Fed has to thread the needle with inflation.
Now, Julie, over to you with some breaking news on the housing front.
Yeah, existing home sales falling 7.2% month over month in February from January to an annual pace of 6.02 million. That's worse than estimated. Economists were just looking for a 6.2% drop, and instead we got a 7.2% drop. And by the way, that level of 6.202 million, that annual pace, is a 6-month low. Part of it could be affordability. That's something that the National Association of Realtors chief economist said in a statement accompanying the report. He said housing affordability continues to be a major challenge as buyers are getting a double whammy, rising mortgage rates and sustained price increases. And on the former point, of course, Freddie Mac, as we told you yesterday, said that the 30-year mortgage rate, average mortgage rate, had surpassed 4% for the first time since 2019 once again. And one would have to think that it is going to continue to push higher with the Fed raising rates. So there's a lot going on here in the housing market, including a lack of inventory as well as those rising prices, and all of that in the mix here as we see this disappointing number on the housing front.
So let's break down how the Fed's rate hike will impact the housing market. For that, we'll bring in our guest, Lawrence Yun, National Association of Realtors chief economist. Thank you for joining me today. So what changes should prospective buyers or those wanting to refinance, what should they be aware of from now?
Well, the refinancing chance may be over because rates will only go higher from this point. The mortgage rate were essentially at 3% last year. It's already at 4% or slightly above. Most of the increase have already occurred in anticipation of the Fed making several moves this year. So from this point onward, I would say the mortgage rate may hit, say, 4.5% towards the year end because based on the past relationship, Fed funds rate and the 30-year fixed rate mortgage is not 1-to-1. It's the more modest increase in mortgage rate when the Fed begins to increase rates.
And as you mentioned, the 30-year fixed mortgage rate exceeded 4%, and that's for the first time since May of 2019. How much pressure, though, does the Fed's rate hike put on mortgage prices, and how fast we might see them come up?
Well, the first-time buyers have already facing affordability challenges just because home prices have risen so much, 17% last year. So that in itself is very pricey. Now, with rising mortgage rates, that's going to put another, say, 10 to 15% payment burden, meaning that people taking out a mortgage the monthly payment will be rising for people who are in the market, and therefore significant affordability challenges ahead. The only solution is really about increasing supply. I'm glad that today's housing start numbers are beginning to increase. So because we need more and more supply in order to calm the home prices from the rapid increases that we saw last year.
So when do you expect to start seeing perhaps a slowdown in some of this pandemic rush that we saw? And are there still bargains to be had depending on which part of the country you're in or how much house you can afford?
Well, the Midwest region, everything from, say, Cincinnati, Kansas City, and in Michigan is very affordable. So for a middle-income family, it is able to buy a home easily. Now, in the South, it is still reasonably affordable, but the price increases there has been the strongest, whether it is Charlotte, Atlanta, or Dallas, and the Florida market, a super hot market. The multiple offers are still happening even with higher mortgage rates, which is implying that the residual demand is still there. But I think in the second half of the year, some of the first-time buyers will simply be squeezed out from higher prices and higher mortgage rates.
Now, I want to shift gears and talk about some of these supply side constraints that we're seeing on lumber, building materials, adding on top to rising construction costs. And that's on top of that expectation then for higher interest rates. We're seeing that affecting builder confidence. How concerned are you about that and how long that might last?
Well, the builders, they're making profit. There is an economic incentive, financial incentive to produce more. Of course, there is that supply chain issue and higher material costs, lumber prices rising and other material costs rising, construction workers, hard to find those skilled construction workers. Yet the builders are tacking on this added cost to the final price, and the consumers are saying, oh, fine, I will pay the higher price. So the builders have incentive to produce more. Now, we also need to consider, especially in some big cities, about repurposing some disused property, maybe some office building, turn it into condominiums, or maybe a shopping mall, turn it into some more residential units, because we need to consider all aspects of supply, not only about housing starts and building new homes.
And you raise an interesting point. We're seeing a lot of churches also being converted now into apartment buildings, given all the space there. But obviously, we did have this rush during the pandemic. It was so incredibly intense. Some of these listings were up for perhaps hours in some cases. And we saw what people were willing to do, willing to go far above the listed price, waiving inspection, all sorts of things. What are the trends you're seeing now with demand? And what do you think will continue to drive it?
Demand as of yet is still very strong, perhaps not as the intense multiple offer situation, but the multiple offers are still prevalent, say 3 or 4 buyers competing for the same home compared to say 20 buyers 1 year ago. But multiple offers, I think that will steadily dissipate as we get more supply. More supply means people do not need to make hurried decision. And furthermore, some decline in demand from rising mortgage rate, so some movement towards normalization. And I think that's a healthy development because we had this intense housing shortage leading to, where people are just waiving appraisals, waiving home inspection, which sometimes people feel very uncomfortable about.
Welcome back. Pending home sales dropped for a back-to-back month in December as some key measures of housing market activity cooled at the end of 2021. Yahoo Finance's Inez Ferre is here with the details. And Inez, this drop in pending home sales came even before the jump in mortgage rates that we saw at the beginning of this year.
That's right. That pending home sales index in December falling month over month by 3.8%. The estimate was for a fall of 0.4%. Year over year, the pending home sales index fell by 6.9%, and the estimate was for a fall of 4%. So this signifies extremely tight inventory, and the total housing inventory in December was down 18% from November and down 14.2% from
from 1 year ago. Houses have been selling 10 days faster than a year ago as home hunters are scrambling to try and buy a house as the mortgage rates have been ticking higher. You've got the 30-year fixed mortgage rate average at 3.55%, and it's only going higher from here. And these home buyers are just trying to grab any type of inventory that they can amid tight inventory.
Inez, it's understandable that people fear of missing out, especially with interest rates where they are. But you've spoken to first-time home buyers and hunters. What are the trends, personally? Is it a fear of missing out that's driving them? Is there something else? What are they telling you?
Well, they're telling me that as the mortgage rates are ticking higher, they fear that they won't be able to make the monthly payments because those monthly payments will be going higher and higher with those mortgage rates. So they're able to afford less and less. I spoke to one home hunter in southern Texas, and I'm writing a piece about this. He's been looking for about a year now. He tells me that the houses that he was looking at a year ago are almost double in price now. He's looking at that range between the $100,000 and $200,000 level. Anything below $200,000, he's telling me, are fixer-uppers with very little land to them. And he feels a sense of urgency to try and buy something before the mortgage rates tick even higher, and he's priced out of the market. And just to put a fine point on this, Zillow Research came out today with data showing that the data showed that the total value of the U.S. housing market in the U.S. surged by almost $7 trillion in 2021 alone. That is the biggest growth in the residential market for any given year.
Home prices in focus here today as the January U.S. home price growth was 19.2%. We're going to dive further into the exact metrics in a moment, but take a look at some of the movement that we've been tracking here for home builders as we've been tracking across both new homes and existing homes. Of course, data has already shown that existing homes inventory has continued to drive some of the prices of those existing homes that are on the market higher. Meanwhile, it's been hard for some of the new home builders out there like a Lennar, like a Toll Brothers, to actually execute because of supply chain crunches as well. However, you're seeing all of these companies move higher, including the ETF that tracks the S&P 500 home builder segment, the XHB, that's up on the day by about 3% on this news. We're going to go further into this data in just a moment. David?
Thank you, Brad. Let's talk about all that with Debbie Boyd. She is the CEO of DLB Financial Services. Debbie, nice to see you. Brad just showed us those numbers, 19.2% in January year over year. That's up from 18.9. How long can these prices stay so hot? And what are your other big takeaways from the report?
Well, I do think it is indicative of what's going on in the market. We've got that perfect storm right now. We've got COVID that did the supply chain problems. We did COVID that drove people to work from home. Now companies know that people can work from home. People know that they can work from home. Now they're moving. They're moving to states that have lower income taxes, if any. They're moving to states where their families are, or they're just moving to states that are prettier and they want to be in. Now that you can work for anywhere, it really has changed the game of employment.
What are specifically those hottest markets? And is there one particular common thread among them? You mentioned some of the possibilities. Could it be jobs? Could it be taxes? Could it be weather? Could it be a labor market?
I think it's all of those things. I think, I'm here in Dallas and we have a lot of people moving from everywhere else but here. So our people are sitting still. Everyone else coming in, Chicago, Atlanta, New York, Boston. And then we've got the West Coast. We've got people from Washington that are cashing in those expensive homes and buying twice what they can buy up in Washington or in California, pocketing the money and investing it or buying rental properties. So it's really a great time to move your money around in different types of events that you maybe couldn't last year.
The three hottest markets, Phoenix, Tampa, and Miami, up 32%, 30%, and 28% respectively. How do you expect that mortgage rates on the rise will impact the market?
The prices going up are one thing. Another thing is those interest rates. So when the interest rates go up, It's not going to deter you from buying. If you're going to move, you're going to move. But it just means that you're going to get less house now than you could last year by quite a bit of percentage. So yes, can you move to Miami proper? Maybe not. Maybe you can't afford to be in the city now. The prices are 30% more than they were last year. So you're going to be in the suburbs of Miami. It's going to change the way that we live, and it's changing the way that we're using our money. A lot of people are cashing out of their 401ks and investing that money into real estate, while you have people on the other hand moving money from the stock market and they're putting it into real estate with investment properties. So we got a lot going on right now.
In terms of those mortgage rates, how high do you expect them to go? And is there a point at which it will cool off the market?
I think it will cool off in a little while, but not anytime soon. I think this year we're going to see close to 6%. So rates are going up just with the Fed talking. They go up a little bit, but with the threat of the Fed talking, they go up a little bit. So we're already a whole point higher than we were in December. And the Fed's only spoke once. So are they going to raise it 7 more times? I don't know. But just the idea that they can raise it if they want to, which has always been out there, but now people are talking about it, the rates are going to self-regulate.
Perfect storm right now with demand so high and inventory so low. And inventory is the big question moving forward. Been relatively flat. And Brad mentioned some of the factors. Why is it that home builders aren't increasing inventory?
Well, they can in a lot of cases. I'm in suburban North Dallas area where we have all the major home builders build here. And you know what? They're selling 2 houses at a time per month, where they used to be able to sell whatever they wanted. So no, they don't have enough lumber. They don't have enough sinks. They don't have enough electrical boxes. People don't have enough, and there's not enough workers to go around. So yes, you can get your roofing done, but it's going to take longer because the companies are stretched more. A lot of people are not working in the trades like they used to. So there's an extra demand, and he who pays the highest price gets the workers right now.
Great point. The labor market is very tight. So Bank of America said housing affordability is its worst it's ever been. If you are a buyer who's struggling to find something in this market and think, all right, I'm going to wait out this bubble, what's your advice?
It's not a bubble, so don't wait it out. The rates are going to be higher. That means you're going to have less of a house next year. More houses are coming on the market all the time as people try to figure out what to do. But the problem is, if you're going to sell your house, you've got to have somewhere to move. So one guy I talked to today, he's moving out of the country. Great. So his house is going up for sale. Another man's in a 2-story house. He's retiring. He wants a 1-story house, just doesn't want a big 2-story house anymore. So he's going to something smaller. You really got to have a reason to make a move. The equity that you're getting off of it, a lot of people are doing a cash out refinance, paying off a lot of debt, or they're buying investment properties, but they're staying put. So we have reverse mortgages making people stay put, and where are you going to go? So you have to be able to move somewhere to make it worth your while.
Mortgage rates just hit 5% for the first time since 2011. According to Freddie Mac, the average 30-year fixed mortgage rate in the US is up 0.28% from just last week and nearly double the all-time lows of 2021. And with rising rates go monthly mortgage payments, which experts estimate could be up by about 38% from just a year ago. Now, despite surging mortgage rates, we probably still won't see home prices come down anytime soon, as demand continues to outpace the dwindling supply of homes in the US. Fannie Mae forecasts an 11.2% year-over-year jump in existing home prices for 2022 to $384,000. So still a tough market there for home buyers.
Sellers have all the power, and there is no inventory. 729,000 homes on the market. That's down 25% from a year ago, down almost 50% from 2 years ago. And paying list, that doesn't usually get it done right now. Redfin says almost 6,000 homes in the first 6 weeks of this year sold for more than 6 figures above list price. So how about buying a gift for the seller as an enticement? That is now common practice around the country. Let's talk about it with Daniel Del Real, who is a realtor in California. Daniel, good to see you. First, before we get to that now interesting technique, what are you seeing? How hot is the housing market in California?
Well, it hasn't cooled off. We saw a 29% increase in pending sales last month. So even with the rate going up, the first 30 days of the year, the buyers are not letting down.
So you say the interest rates, which we expect to go up on Wednesday, has no impact?
Well, the interest rates we expected to go up to 3.75 by the end of the third quarter. We saw that in the first 30 days of the year. So we were looking very closely to the numbers to see how buyers would respond. And last month, we saw a 29% increase in pending sales. So I think, the story's been told, and a lot of these buyers are feeling the pressure of inflation, rents going up, cost of goods going up, and they're seeing that the buying a property for them might be out of reach. So they're coming in, they're locking in 30-year mortgages at 4.1, when inflation's sitting at about 7.5. It's enough for them to jump off that fence.
California is home to more than half of the country's $1 million cities, those cities in which a home purchase averages $1 million or more. And Daniel, it's such a frustrating process for buyers right now. I'm actually a realtor in Connecticut, and they're beaten down. They're convinced that they actually cannot afford a home in certain cities across the country. And now they're turning to gifts. What kind of gifts are you seeing people offer to the sellers?
Well, the tactics change in real estate. And what you're seeing is, we've seen gifts of nursing, custom nursing gear for nurses. We had a client send a seller to Hawaii to meet up with a daughter that he hasn't seen in a while. And so when they were in the home, they were kind of looking for clues and asking the right questions to the seller and the agent. They found out that the gentleman hadn't seen his daughter in over a decade. And if for this gentleman, he was in his mid-70s, so most of his net worth was tied up in the equity of his home. So it's not like he had the money to go to Hawaii, or if he did, he would be more conservative with it. So this buyer stepped up and said that they would pay for a round trip ticket to Hawaii to see his daughter. And it wasn't really the trip that sealed the deal, but it made it memorable. And it gave the buyer an opportunity to have a seat at that table where you were competing with some non-contingent offers, cash offers. And he just saw that as a soft spot for him, and it gave the buyer a seat at the table to actually get an accepted offer. Now the buyer had to go up and offer an amount that made sense for the seller, but what it did is it gave them a seat at the table for that negotiations. And sometimes buyers do that. Like when we do that as agents, we do it just so you can have a memorable offer. Right? We've had Netflix subscriptions, car washes, and if you have 10 offers and they all have some form of contingency and you don't have a cash offer, usually it gets a giggle out of the seller and says, well, okay, let's counter all these offers and throw the one that's offering the Netflix subscription as well. And again, it's just a tactic to make the offer memorable, and then at the same time, give you an opportunity to have a seat at the table to potentially, get the deal.
Still assume cash is king, and a cash offer above list, does that generally get it done? It used to be the love letters that people sent to the sellers. Is that still a practice? And are there limits to where you want to go with these gifts? Can they become too personal?
Yeah, and sometimes they can. So letters are not allowed anymore. So that opportunity to tell your story to the seller wants a family to move into the neighborhood. You can't really write those letters anymore. So now you have to find a different way to try to connect with them. Sometimes the letters can be too personal, and you have to tell buyers, hey, cool off a little bit. But we've had a buyer offer a seller a 12-month supply of cat food and cat toys because after speaking to the seller a bit, because the seller was older in the property, realized that she just lost her husband, and she said that the husband was the cat's favorite. So there's pictures of the cat and the husband, the wife, and all this other stuff there. So sometimes you do run that fine line of saying, okay, is it too personal? But then again, the seller is just, they want to make sure that there's some form of personal connection on the other end. And with cash offers being 20% of the offers out there, there's still that 80% that aren't getting cash offers. And, with contingencies that the way they are, where some people still have inspection contingencies and appraisal contingencies, it might take that little difference to secure the deal for you. And it's been working fairly well for us here in in California.
We got existing home sales just now, came in at an annual pace of 5.77 million. That is in line with estimates. However, we had a revision downward for the prior month, and it's also the lowest level since June of 2020. We know what's going on out there, right? There's lower inventory because a lot of people who wanted to sell their houses when the market was hot have already done so. And secondly, higher mortgage rates hitting 5.25% in terms of the 30-year fixed. So both of those things putting a little bit of pressure perhaps on the housing market. So we'll see how those numbers continue to look. By the way, we also got an update on Netflix. Biggest drop since 2004.
Oh,
2004.
I was just getting out of college and I was not watching Netflix.
No.
But wearing Abercrombie cologne.
Yeah, most people weren't watching Netflix.
Fair enough. All right.